So there's a huge problem bubbling up right at the core of the US economy. And the plan to fix it? Well, it's a multi-trillion-dollar gamble. In this explainer, we're going to break down this whole high-stakes idea, what's causing the crisis in the first place, and, why the whole thing might be about to fall apart. Okay, so right now, if you look at the analysis, the US economy is basically standing on two giant pillars. You've got the AI investment boom on one side. Money from all over the world is just pouring into that. And then you've got the other pillar, the one we're really digging into today, the US bond market. The thing that's supposed to be the bedrock of the entire global financial system. For forever, it seems, US bonds have been the safe haven asset, the safest thing you could possibly own. But what happens when that idea starts to change? What if one of those huge pillars, one of those foundations, starts to crumble? Well, that's not a hypothetical. It's exactly what's happening as we speak. All right, that brings us right into our first section. We're going to look at the warning signs, the signs of weakness showing up in what's supposed to be the most stable market in the entire world, US Treasury bonds. So you've got the AI pillar standing strong, but that bond market pillar, it's looking really shaky. The problem, at its core, is that nobody seems to want long-term US debt anymore. And what's really weird is that usually, when the economy slows down, investors sprint towards safe long-term bonds. But right now, they're running the other way. Let me give you a concrete example. Just recently, there was an auction for 30-year bonds, and it ended with something the pros call a tail. What does that mean? It's simple, really. There just weren't enough buyers willing to pay the going price. The Treasury literally had to sweeten the deal, offer a higher interest rate just to get rid of them. And that's a massive red flag. It tells you investors are starting to think, hey, if you want me to lend you money for 30 years, you're going to have to pay me a lot more for that risk. So, why the hesitation? Why are buyers getting cold feet? Well, let's jump into the next section, because the numbers behind all this are pretty mind-blowing. It all boils down to one thing: the absolutely massive scale of US government debt and spending. Okay, get ready for this number. This was the US government's deficit for the month of October. Yeah, just 1 month, not a whole year. It's the worst start to a fiscal year in the country's history. And it's not like the government isn't making enough money. The problem is that spending has just gone through the roof. And that just creates this dangerous snowball effect, right? More spending means more borrowing, and more borrowing means higher interest payments. It just gets bigger and bigger. Right now, the interest payment on the national debt on an annual basis has hit an insane $1.2 trillion. Think about that. Over $1 trillion a year, not to build anything new, but just to pay the interest on the money we've already borrowed. And this chart really puts it all into perspective. It shows you just how serious this is. For the first time ever, the US is spending more money on interest payments than it does on its entire national defense budget. Let that sink in. We're spending more to pay our creditors than to fund the military. Look, this path is completely unsustainable. You just can't keep going like this. And that's why some people are floating a really wild, out-of-the-box solution. This is where the whole idea of a crypto lifeline comes into play. This quote from the source material really nails the idea. It's a total Hail Mary pass. The plan is to somehow create a brand new, massive source of demand for US debt by tapping into the world of crypto. And the key players here are something called stablecoins, cryptocurrencies that are pegged to the US dollar. So how is this supposed to work? Well, in theory, it's a three-step process. Step 1, people living in countries with shaky currencies, think high inflation, buy these dollar-pegged stablecoins to protect their money. Step 2, the companies that create these stablecoins need to back them up with actual real-world assets. And here's the big assumption. The plan is that they'll buy super safe, short-term US Treasury bills, or T-bills. And if that happens, what's the result? Boom. You've just created a brand new fire hose of money aimed directly at US government debt. And the number they're hoping for is just huge. The proponents of this idea think there could be as much as $3 trillion in global demand for stablecoins by 2030. And in this perfect world, all of that money would be used to buy up US bonds. It sounds pretty clever, right? A modern solution for a modern problem. But is it actually realistic? Well, let's move on, because when you start to really look closely, the whole plan begins to show some serious cracks. Okay, problem number 1 is just the sheer scale of it. The plan is banking on $3 trillion in demand, but the entire market for the two biggest stablecoins combined right now is only around $200 billion. That's not just a gap. That's a canyon. It's a huge leap of faith to think it can grow that much, that fast. But honestly, that's not even the biggest problem. The real flaw is the assumption that all the stablecoin money would automatically go into safe US T-bills, because it's just not happening. Let's take a look at Tether, the biggest stablecoin out there. According to an S&P assessment in the source material, almost a quarter of their reserves are parked in high-risk stuff, not boring old US government debt. So why on earth would they do that? Well, it's just basic business. First off, the dollar itself is losing purchasing power. So if you only hold dollar-based assets, you're slowly losing money. To stay competitive, these companies need to earn a better return. I mean, think about it. If every stablecoin company just bought T-bills, the only way they could compete with each other would be to cut their fees, which just leads to a race to the bottom where nobody makes any money. So they have to take on more risk, buying things like corporate bonds, gold, maybe even some Bitcoin, just to stay in business. And if you need one more piece of evidence, analyst Luke Grumman, who's cited in the source, basically puts the final nail in the coffin. He ran the numbers. Even if we're super optimistic about the growth rate, he says it would still take about 23 years to hit that $3 trillion target. And by then, the annual US deficit will probably be something like $5 or $6 trillion. The solution, even in the best case scenario, is just too small and too slow to fix a problem that's growing way, way faster. So if this high-tech crypto fix is basically a pipe dream, then what's left? What's the alternative? Well, according to this analysis, the answer is pretty uncomfortable. It might mean turning to a major geopolitical rival for a bailout. This quote, which the source attributes to Donald Trump, is pretty jaw-dropping. It's a direct request to China's President Xi to buy more U.S. agricultural goods and to do it faster. It really paints a picture of a relationship where the U.S. is in the position of asking for economic favors. And this table here shows you exactly where that leverage comes from. The U.S. is just incredibly dependent on Chinese supply chains. We're talking about everything from everyday stuff like toys to something way more critical, like rare earth metals. China has a near chokehold on refining those, controlling something like 90% of the world's capacity. That kind of dependency is impossible to ignore. And it's not just theoretical leverage. China is apparently using it. The source talks about this system they have called the Validated End User System. It's basically a way for them to control who gets their rare earth exports. And what's the alleged goal? To make sure these super important materials don't find their way into the hands of U.S. military suppliers. I mean, that's a direct hit on American defense capabilities. And that all leads us to the final, really tough question here. When a homegrown, high-tech solution seems like a fantasy, and the debt just keeps spiraling out of control, what's left? Is the only real option to start making deals and concessions with a strategic competitor just to stay afloat? That's the core dilemma this analysis leaves you with. It's this incredibly difficult choice between facing a harsh financial reality and maintaining geopolitical sovereignty.